Well, the market's finally decided to do it. It's broken out of the daily balance area in the upward direction. This range had proven to be really frustrating for both longs and shorts. What's going on, traders? This is, of course, the weekly watch list, where I'll be doing a full technical analysis of everything that you see listed up above here, as well as presenting 2 additional trade ideas towards the end of today's video. If that sounds good, I would quickly remind you that anything we're associated with is linked down below in the description. A quick thumbs up on the video goes a long way to support the channel, and with that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've got yet again another hammer candle. However, this one has a green body. So buyers definitely stepped up at the lows and were able to push prices back up to the opening print. But we go through the opening print for range expansion in the upward direction, so I would say from a structural perspective, buyers do have the upper hand. In terms of location on the bar-to-bar count, we did produce a weekly higher low as well as a higher high, and most notably closed above the original hammer high right here. So from a location perspective, again, buyers do seem to have the upper hand. Let's not forget, though, that the overall context of this trend is still down. We've got a lower high off of the resistance trend line, and we still are underneath the bottom of the weekly balance from this area right around in here. If you recall from last week's episode, there were 3 distinct steps that needed to happen if the weekly trend is going to reverse, and we've only accomplished one of them. The first step was closing above the first hammer's high. We did that as of Friday's close. Step number 2 is recapturing the bottom end of balance. We have not done that yet, and obviously step number 3, breaking the resistance trend line, has also not happened yet. If those remaining 2 steps do happen, then yes, of course, we would start to look at this and consider this a strong weekly higher low, but until those 2 steps happen, we are still in the context of an overall weekly downtrend, and we know the objective should be to test the equal lows much closer to 355. So steps in the bullish direction, but overall not out of the woods yet from the overall trend on the weekly. Let's have a look at our volume profile and see if this continues to support that sort of idea and line of analysis. I would say yes, the 390 high volume node could offer some resistance now that we're testing it from the bottom side up, and I would also continue to remind you that this is turning into a dual-tipped high-volume node, indicating that the lows of the prior 2.5 weeks worth of balance are basically the gatekeeper before falling through potentially the low-volume void into the Great Reset, the pre-sickness highs much closer to 340. I'm not making the argument that a breakdown here this week would cause that full flush. I'm just pointing out where there is support from a volume-based perspective. Let's have a look now at the daily time frame chart and see what we've got going on from an expected move perspective, psychology, location, all that good stuff. So here's the weekly expected move. The upper edge is 397.92 and the lower edge is 378.31. If we are contained by the upper edge of the weekly expected move, it still could produce a lower high from here to here, but you can't argue with the fact that it would be a solid break of the balance and more than a double of that range. So it's neutral to bullish depending on how you want to look at it in this interesting market juncture. I would probably give it more of a bullish edge this upcoming week for the expected move. Of course, just traveling back down to the lows is an equal low on par with the lows of the daily balance that we are breaking out of as of Friday's session. Let's have a look at the intraday breakout from Friday. I want to talk about the psychology of what took place early on in the session. We know that we got some jobs numbers that morning. We also got the services PMI. Notice the dip and rally, right? So if the sellers were going to make something happen, they should have capitalized on the early morning momentum on Friday's session. It just didn't happen, and the buyers run away with it into the close. So carrying that forward as a bullish data point, let's go back to the daily time frame chart and see what's on tap in terms of levels that could potentially be in play. We know that 389.50 is the weekly high volume node. It's the weekly resistance level. It's the daily 50 SMA, and it's also, if we go ahead and throw on our anchored VWAPs to the dips of 2022, the resistance band, so to speak, in this area, right? So we aren't expecting a smooth sailing ride up to the upper edge of the weekly expected move. I would imagine that there is some battle that's done at 389.50. It could prove to be an area of hang up for the market. But when and if it breaks, the next major target is really the bottom of the weekly balance that we were just discussing as step number 2 for changing the weekly trend. That number is 394.50. In the context of the daily trend, remember that it is still down, right? This is still constituting bear flag consolidation. If we take out our Fibonacci's, this will prove it, right? Coming in from the high to the low. Although we've broken out of this as a daily balance range, we still remain underneath the 38.2 confluence of resistance at 389.50. So if this pattern remains in play as a bear flag, and if the market rotates back down underneath 385.50, really not much has happened in the bullish direction. What would be a bullish development for this upcoming week? Two things. Number one, obviously continuing through the 389.50 area, that's weekly resistance. Or number two, a pullback that finds a higher low off of the top of balance would also have me feeling more bullish than bearish. So pullbacks that now hold 385.50 could possibly be offering a daily higher low, and from there we would have to watch and see if we get that move into 394.50. So to sum it up, we're not out of the woods yet from a bearish perspective. There are still bearish overtones on the weekly time frame chart and the daily time frame chart as long as we remain underneath 394.50. We do know though that if we break through here, we would be violating the 38.2, so no longer staying in bear flag consolidation, or if we get a pullback, early on in the week, something that now respects 385.50 also could offer a daily higher low, and then from there, make that rotation to 394.50. What do the bears want to see? The bears want to see a big rejection off of 389.50 and a move back down into the balance area for a look above and fail, and then we would target the bottom end of the range, much closer to 375.50. From there, looking for the bear flag on the daily to play out and bring us much closer to those weekly lows that we know we're targeting around 355. So those are the situations for both sides of the trade into the coming week. Just to sum it up, the critical levels that you need to be watching: 385.50 for higher low pullbacks, 389.50 for the possibility of a rejection, and your target overhead really wants to become 394.50 if the bulls are going to make a stand and get some price acceptance towards the bottom of the overall daily balance from back here. Does this all make sense from an internals perspective? Let's have a look. If you don't know what this screen is, top right hand corner's got you covered with a brief market tutorial on that. What do we see in the volume perspective? So really significant. This is really confirming that we did have some significant inflows to the market. The bullish activity was supported by the underpinnings of the market. So inflows breaching 300 million both on the Wednesday and Friday session. Inflows here getting right up above 500 million for the course of the week. Overall, I would say that the distributions here are far more bullish really than the moves that happened here. Notice that on Monday that was last Friday. But on Thursday's session, right, we are getting more of that upward trend in the advanced decliner instead of staying pegged down here in the trend lower zone. So advanced decliners look good, and honestly the ticks on Friday are really the tell. Remember that ticks will always light the way. Notice that this is a clean trend, pull back and continue to trend higher into the close. This is not indicative of short squeeze. Short squeeze is always blast in the morning, flat into the close. Notice how this continued to trend into the close, and you can see clear as day in the distribution that almost all of the activity throughout the entire course of the day was above the zero line. So not seeing any major divergences in the internals. This would support more of a bullish thesis going forward, or at least a higher low pullback being an opportunity into the early stages of this upcoming week. Let's see what the market profile has to offer us. This is really interesting. We've got a triple distribution from the Friday session. So here are just the three distributions, and quite simply put, as we watch this going forward, bulls are most content in distribution number 1, more neutral in distribution 2, and 3, of course, sellers, that's your look above and fail situation that we just described on the daily time frame chart. So look above and fail if we firmly come back down underneath 38.75. That's even a little bit deeper than the top of the balance range, right? I would say a critical level from a market profile perspective is the sort of single print division from the upper and middle distributions right around 39.05, 3900, 3905. This general area, if we get a very mild pullback on Monday morning and support off of that, that would be fairly bullish in my estimation. That would be the main takeaway from the market profile. In terms of the volume, of course, value area did develop higher from Thursday to Friday, and point of control is discernibly higher as well, almost closing up towards the highs of that day's session. So that does strike me as being more of a bullish data point than a bearish one. I would point out that if the market does rotate all the way back down to the lows, this is really low on the list of things to be paying attention to, but we do have a poor low from Thursday's session way down there, roughly 38.23. So carry that forward if there's a look above and fail, but as of right now, it does not seem to be in play based on the evidence that we can see thus far. Let's move back on over to the platform and have a quick tour through our sectors. I'm just going to go ahead and turn off our anchored VWAPs. Just the 50 and 200 SMA will be good for now. Let's look at the weekly change, right? So the weekly leader was the XLC, coming in at 3.75% in the positive direction. After that was materials, financials. Bottom of the barrel was the XLK, coming in at negative 0.83% change on the week, and XLV just underneath 0.21%. Let's look at the structural charts, but seeing the XLC act as a leader, it's actually quite interesting, noting that this had really been struggling to show any relative strength as the market had been rallying throughout the course of October and even early November. Here's the balance area, right? We're firmly back in the balance area. We've broken out of here. There was no look above and fail. That did not happen. There is, clearly an opportunity now for a higher low well above 47.85 and the 50 SMA. There was also not really much of a hang up around 49.20, which was the prior lows of this balance area right here. We just poked right back above. Now we want to see bull flag consolidation and continuation. XLC is actually much more of a risk-on sector as opposed to defensive. So seeing this outperformance does strike me as a solid data point for the market. It will become much more meaningful if we can take out 52.17 in the upward direction. XLB materials, really strong break of this range. Unfortunately, it's a really lightweight sector, so we're not going to read into it too much. Still an opportunity for a lower high from somewhere here to here and remaining underneath this balance and overhead supply. So step in the right direction, not all that meaningful for the market. XLF, though, definitely more meaningful for the market. Remember, we had discussed that there were cleaner, higher lows in place on the XLF. Beautiful pullback, hold into the Friday session and rally. So 34.50 is your critical support going forward. Now we can't really afford to get back down underneath this breakdown point. And if the market starts to break, actually it is breaking already. If I throw on a trend line, just a quick sketch from these highs, right? We've actually broken that on the Friday session. So I would say buyers are doing something impressive here in financials, and being one of the heavier weight sectors, it's technically third by market cap. This is really meaningful for your S&P 500. The next hurdle, of course, is 35.75. Just to sum it up, as long as we're above 34.50, positive force for your S&P 500, trying to build out a bull flag in the face of this, mild pullback and like maybe a weekly high or low or something like that, and then continuation, right? So XLF actually looks decent for some upward activity. Same thing with the XLI. The industrials had acted as a market leader throughout the entirety of the October rally, and it also is back above its sort of ascending triangle breakout as of Friday around 99. So we've recaptured the bottom end of this prior overhead supply, right? Boom, boom, breaking out. I would say consolidation here is much more healthy as opposed to bearish. Bearish moves would be back down underneath 99, triggering much more of a look above and fail. That would be concerning, obviously opening up the door for a bigger move lower underneath 96.81. But one step at a time. So far, actually quite neutral for your market, if not slightly more bullish than bearish. Let's have a look at the real estate sector. Really lightweight, has much more to do with the wealth effect. As we know, it's still stuck in between our two sort of, offside posts, if you will. Over 39 becomes much more bullish, and underneath it's really 34. These lows down here becomes much more bearish. So far, just neutral here as we go sideways in real estate. XLY, sure, it did have a decent close on Friday outside of this balance area in the upward direction, but let's not forget about the overall location of where this is taking place. Still far underneath the overhead supply from in here. Still a strong opportunity for a lower high off of 135, a strong opportunity for a lower high off of 137.50. This is not out of the woods by any stretch of the imagination. Intraday, don't get me wrong, any upward pressure is going to help support your S&P 500, but how long it lasts, that's ultimately the question, noting that we are still in a very strong daily downtrend, again, looking for those lower highs underneath 135. So if we get there, maybe it's bullish pressure early in the week, but when and if this starts to reject, that's where you start to be cautious in your S&P 500 as a whole. XLP, consumer staples. This, as we know, is much more deferred defensive, risk-off type look, and it's actually breaking out over the top of the double bottom neckline. The more time it spends over 75.65, the more sort of reserved I would become in your S&P 500. Not really thrilled to see this acting as a market leader. It would be much more impressive if the XLC could break out over the top of its balance and the XLP wants to stay sideways and really start to build out this as more of a neutral area. Next up is the XLE for the energy sector. This too is deferred defensive and risk-off. It attempted to get over the top of the balance on the Friday session, but I love the upper wick that formed right off of the 50 SMA as well. Now, it did come exactly from the bottom all the way to the top of the range and then try to break, so we've got to give it the benefit of the doubt and say that there's an opportunity for a higher low and a reattempt at this point in time. But if we do get more firm price acceptance underneath Friday's low and drive towards the midpoint of this range, that would be feeling much more comfortable for the XLE and the defensive sector cooling off and not necessarily having an opportunity to lead the market rally in the upward upward direction. Utilities as well, right? Just the same. D for defensive, risk off. Notice that this did not attempt to break the top of the balance range. It did on Wednesday and it came back in, but what did it do, right? It found technically a higher low set around that 50 SMA. If it gets back above 7140, that wouldn't be the best sign for our S&P 500. Keep an eye on utilities. This one is really probably the most important of the defensive sectors. Next up, we've got the XLK for the tech sector, the most important sector of them all, considering it's the heaviest weighted sector of them all. And just like we talked about in the XLY, still some, lack of improvement. Same thing in the XLK. So this is a big counterpoint. We've been talking pretty bullish so far about the sectors that we've been, running through, but the XLK being the heaviest weight, being well underneath 129.50, not even attempting to break up and over the high of Tuesday, nowhere near the 50 SMA. It's very hard to have a risk-on look or a risk-on attitude towards the market as tech is still lagging so much, right? So XLC, great, impressive, but it's not quite as heavyweight, obviously, as your XLK. So this really needs to start to show and prove. The first step would, of course, be getting some higher lows above 124.50. So continued breakout and then a pullback that proves a higher low above. That would be much more constructive for the market, but we can't make any assumptions about that just yet. There's still clearly the opportunity that this is consolidating in a bear flag. We could be rejecting off of that resistance trend line, so on and so forth. So bearish until proven otherwise, unfortunately, in the XLK. XLV, the healthcare sector, this is actually quite bullish. Noting the lower wick from the Friday session, it takes out the low of Thursday, right into support here, and here, as we've been talking about in the past. 133.50 is the area to kind of watch to keep the XLV afloat. And where did it close? Right back in the overhead supply, right? So because of that, you could technically say this was a balance. This was a look below and fail. Target should be the top of the range. And if we get there, there's the opportunity now for a breakout over 137.15. That does strike me as bullish for the market, noting that this is, of course, the second heaviest weighted sector by market cap. Let's have a look at our ratio grids now. If you don't know what the ratio grids are, this shows us relative strength and weakness in the sectors. Top right-hand corner's got you covered with a brief tutorial on how to set it up. Top four are the risk-on sectors. Again, look at your XLK. Struggling, not looking great. XLV is pulling in a little bit, but still above an upward sloping 50 SMA. XLF, as we talked about in last week's episode, the opportunity for great outperformance, it followed through. So really, like a proud dad at a soccer game, right? Good job, XLF. You did your work, right? So really, happy about what's going on in the XLF, but the XLY is just a counter trend move in an overall glaring downtrend. 50 SMA is clearly pointing in the downward direction. XLI looks decent, but not, unfortunately not a really heavyweight risk on sector. And the same thing with the XLC, as we just pointed out in the structural charts. XLP continues to curl in the upward direction, so this is not indicative of risk on. Energy going sideways is not indicative of risk on. And utilities, again, just a counter trend move in an overall uptrend, not indicative of risk on. Same thing with real estate going sideways as well. Really tough to have a full-blown risk-on type look when our ratios are looking like this. Let's have a look at the weekly. This is an interesting look. This is the weekly XLP. All right, so a much broader look at the XLP ratio, in relationship to the SPY. You can see that right here, XLP divided by SPY. What I wanted to point out was this weekly trend line, which has offered up resistance. There's the anchor once, twice, coming into it for a third time. And notice that each time we get here, or each time we peak in the XLP, it coincides with a market bottom, right? So if I just do something like this, we can sketch them in there, kind of do something like this. Of course, that was the sickness low. Could this possibly be the start of a market bottom? Maybe. If we reject and if this ratio starts to deteriorate, so to speak, off of the resistance trend line, it's not a guarantee. It's just something to keep in mind and in our back pockets as, a data point moving forward for the bulls. If this turns over off of the trend line, it would be much more bullish than bearish. A counterpoint to that argument directly, though, is the ratio between the XLY and the XLP, so growth versus value. You'll notice that this made its counter trend move, and as of the close on Thursday and Friday, it is actually starting to roll over ever so slightly underneath that resistance trend line. This is not bullish for equities by any stretch of the imagination. Let's have a look now at the dollar. So the Dixie is up next. And as we pointed out, it was trying to pick the liar between gold and the dollar. I still think that gold is telling the truth, the dollar's lying. This wants to break down, in my estimation. We want to see more of a firm break underneath the bottom here, which, it coincides with higher equity prices. So if you're a bull, then you want to see a breakdown of the dollar underneath roughly, what is that, 103.30s? Yeah, 103.30s right around here. And you want to see the continued breakout in the forward/GC, the gold contract, right? And this is why I think the dollar's a liar. Look at how much more meaningful the breakout is in gold as opposed to that, fake move in the dollar, right? This well above the breakout point on the pullback and closing strong on Friday. I think the dollar has some room to come in, which supports the idea that equities may move higher. So we've got a really mixed set of data points for today's episode in terms of what's going on out there in the market. The next one is fairly mixed as well. Let's have a look at the TNX. This, of course, is the 10-year rate. I want you to start thinking about this on a longer time frame perspective. So if this is a set of highs and this is a set of highs, right? We've got lower highs on the weekly. What cements this as a lower high? Of course, the breakdown of the equal low. So if rates can get underneath 30, it's closer to 34 really. If they can get underneath 34, which is 3.4 in the 10-year, that of course is much more positive for equities seeing some relief and a move in the upward direction. Does this make sense with the TLT as well? Yeah, absolutely. Let's have a look at the TLT. Of course, almost just the inverse. You can see that this is the low. High or low, if we can take out this top, that's more meaningful. That's right around 109 in your TLT. One thing that I would watch out for, though, is the relative strength line in the TLT. This is the relative strength line here, the ratio. And if this continues to outperform the S&P, they can both be moving in the upward direction, but if it's outperforming the S&P by a significant margin, that would be much more of an indication that, hey, there's still some flight to safety going on, people taking a safe haven, so to speak, in the bond. So be mindful of that. What can we see from the Fed Watch tool? Wow, this is really small. Let me zoom in on that so you can actually see what's going on here. We're still calling the Fed's bluff. The market is sort of projecting that the terminal rate will be somewhere around 500 basis points, and you can see it will be held there almost steady throughout the entirety of the course of 2023. Again, that's not a guarantee. It's just what the market's pricing in, and that's subject to change because we will be getting some economic data coming out on Thursday's session, some big stuff. It's the CPI read. We'll be early in the live stream. We'll probably start around 8:15 to catch the live market reaction. What I want to point out about this is that the expectation for the market is to have CPI come in flat. That's a really, really difficult thing to achieve, right? Even if we're off the expectation, we're 0.1 in the upward direction, it's probably okay for the market, but the market's really only going to have a really positive response to this data if we're almost negative, like if we are negative in the inflation read and deflationary on the month over month, right? So I think that'll be a little bit of a feat for the market to potentially achieve, but something to keep an eye on. Again, not making any assumptions ahead of time, not positioning early for it, just being noted that we will expect some volatility at 8:30 on the Thursday session. We'll get you covered on that live, the pre-market prep, all right? So back on over to the TLT, as we pointed out, if the CPI comes in hot, we could see bonds start to outperform. We could still see like both things moving in the upward direction, but if the relative strength line is far outperforming the S&P, again, just to point out, that's kind of your red flag. In terms of the business cycle, some improvements have been coming in. Let's have a look at this chart. We brought it up in last week's episode. There it is. So I want to point out, right, something to be mindful of in this upcoming week's worth of trade is the possible top, the confirmation of a top in commodities. Remember that commodities want to top first, TLT and bonds want to bottom second, and then after that, you usually see the return to the bull market in the equities. So if step number one is going to be accomplished, we kind of want to see these lows get taken out in the coming week's worth of trade around 2350 in the DBC. After that, right, if we know that the TLT is going to start possibly outperform, taking out this top here, okay, great, bonds have started to bottom. They will outperform for a little while. And then from there, that's where we're starting to scout from at least a cycle perspective, a bottom in the S&P 500. This is all sort of adding in nicely with what we're seeing in the terminal rate being reflected at 500, not really going much further than that. It allows the opportunity for the TLT to start outperforming and then stocks possibly after that to signal some sort of better bottom, so to speak. Let's have a look at the HYG to determine risk appetite. The SPY completely called the bluff of the HYG in this divergence. And this is actually going back to something that we pointed out in an October video, which was that we started to see the change between good news being bad news for the market. Now good news is actually good news. It's an indication that the Fed has not gone too far with their rate hiking campaign, and they're not going to send the market into a possible recession. Now, whether or not you believe that is besides the fact, but the fact that the SPY has now been calling the bluff of the HYG for a couple of times in a row in terms of these divergences, that is in alignment with that theory, and again, supportive of the idea that, hey, the Fed may have not overdone it in this rate hike cycle. So something to continue to monitor for. Another thing, as we're potentially talking about bullish outcomes here, is to watch for a possible divergence in the Dow transports, right? If the industrials do make this higher high and possibly get above here, we're thinking about a possible break of balance. We're at least expecting some sort of upward lift on the continuation. If that happens, and you can see that there's a clear divergence between where we're at relative to that high in the transports, if transports make another lower high and roll back over, that of course would be a red flag. So this is not something that has happened yet, but I want you to start putting it on your radar as something to be a signal when and if the market does continue in the upward direction to get some confirmation. Okay, so just a precursor, so to speak. Let's have a look at the VIX and some volatility products to round out the S&P 500. This is just sitting down here in sort of this wedge. It doesn't mean that it has to break up or down, but we would expect something to happen in volatility, and maybe CPI on the Thursday session is the catalyst that's going to either push this lower or higher. Remember that market participants, that is a tongue twister, will generally be on edge as the VIX is hovering around 2050, noting that it's a floor of possible support here, and here, and it's led to these sells in the market over the course of 2022. If it perks back up, we know the deal will probably move back down through the bottom of the range here, or the VIX would respond rather to the SPY moving lower under the bottom of the balance. But if it starts moving underneath 2050, that's much more of an indication that, hey, we're a little bit more comfortable than we've been throughout the entirety of the previous year's worth of trade. So watch 2050. That would be the continued number to beat, so to speak, in the VIX. As long as we're above it, we're not out of the woods. If we start coming down underneath it more aggressively, much more constructive for a bullish possible look into 2023. Let's have a peek now at our VVIX, which of course is the volatility of the volatility index, and it's all the way floored at the bottom. There's a theory going on out there right now that, maybe the VIX is being manipulated, and there's also a more logical explanation possibly that, people are just day trading SPY puts, VIX calls, and not necessarily holding them through the close, which would cause the VIX to remain rather low instead of staying up at some elevated prices. So just a theory, but all I would point out from here is the idea of the flood effect, right? We've talked about this in the past. If we get a gamma squeeze, if everybody's flooding into SPY puts, if everybody's flooding into VIX calls, you get something that spirals out of control relatively quickly, and generally the moves are of a much greater magnitude than one could expect, and it's directionless. Right? It doesn't matter what the direction is. Typically, volatility is associated with downward price action, but technically it could go either way, right? So that's the VVIX, again, sitting at historically low levels. Be open to the idea of that flood effect. And then if we come on down to the Contango versus backwardation, this is just starting to perk up a little bit through the trend line. I would not be concerned about this until it starts to move up and over the zero line for a clear indication of backwardation. If you see the 9-day versus the monthly VIX, that is coming in here. I think this is just a bit of a mispricing of volatility when the contracts were still relatively, quote unquote, young, so to speak, for lack of a better term. They're just coming into more of a neutral territory. So not concerned with this. And that is really going to wrap up the look at volatility and our S&P 500. Let's move on back to the QQQ and see what's on tap for our Nasdaq 100 weekly expected move, suggesting again, the possibility of a break or just staying back down at the bottom of the balance. We technically closed above on Friday's session, that 268 level. So watching for that follow through, that would also align nicely with what we've been discussing in the S&P 500, supported by the internals and sectors. That would mean maybe the XLK gets a little bit of a break from the bear flag pattern that it's stuck in. We are still looking for a big time lower high anywhere, ideally anywhere underneath 281.25. So really hard to argue that tech's in much of an uptrend here or as bullish as the S&P 500. Remember, the S&P is much more diversified than just your Nasdaq 100. So because of that, this one still has lots and lots of work to do. I would not look for longs in the QQQ. I think it's much better to look for longs in the S&P 500. Next up, we've got the IWM, Russell 2000, and the small caps. This has been acting as a market leader. Let's see what's going on here. Recapturing its white level, which again is important. If that is going to stay above now, it's much more of a positive indication for the market, moving far above this area of balance, already supporting off the top edge at 174.50 on the Friday session's pullback, right? So this much more indicative of, hey, yeah, there is some decent risk appetite out there, and that aligns nicely with what we just saw in the HYG, to be quite honest with you, right? The high yield bonds. So with everything that we're seeing, I think we're at a juncture in the market that's worth very much so paying attention to. You've also got something called the January effect, the 5-day effect, where the first trading week of January kind of sets the tone for the year. You can go back and look at the statistics. I'm not going to pull them up right now, but the last thing I do want to show you is the side-by-side comparison of the weeklies, just to sort of point out what's going on. So SPY Still, again, not out of the woods. Opportunity for a lower high against 389.50. If we get above, that's where things become much more meaningful. QQQ, nowhere near the recapture area at 281, which is, again, why we're not looking for longs in the QQQ. Much more constructive in the SPY. IWM Russell 2000 and the small caps, you can see above the hammer highs, back above the thick white line. So steps in the right direction, but I would think that the best bet at this point in time is watching for your SPY to come in for the back test of that 394.50. If you're looking for longs, that's the place to be. If you're looking for shorts, a look above and fail on the QQQ daily range is probably the place to be if you're looking for continued weakness in this market. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we'll dive right into Apple, coming right back to the back test of the 130 level here on the daily time frame chart. Breaking that, there's about $5 worth of clearance into the back test of this set of lows here, roughly around 135. It's shy by about 15 cents, but that's your upward target. A pullback here that keeps Apple bullish, wants to spot a higher low over 127.50. Let's not forget that the overall context of Apple is still down, so we're playing very carefully for these counter trend moves. Obviously, breaching these lows puts prices back down in the downward direction, 123.50 and possibly 119 as support underneath us. Netflix continues to outperform. Really, really great movement out of Netflix. It closed the gap, pulled back off of it, found the higher low support at 303, right back up at the highs. I would watch for continuation into roughly that 330 area. Be mindful that earnings are usually first in Netflix when it comes to the tech roundup, so that's around the corner, but so far so good, well above the double bottom neckline from right around in here. As long as that 303 holds, continue to look for bullish outcomes in Netflix. Tesla getting a little bit of a dead cat bounce on the Friday session, but is it all that meaningful? It's hard to say just yet. I mean, this thing is still an untouchable for the market. Big downtrend. I mean, just undercut the lows on a gap down, some capitulation, so to speak, on this Tuesday open, right? Look at the red volume there. Really, really significant. If it takes out these highs, maybe we can play for a counter trend move early on in the day's session. Over 113.50, 123.75 is the target, but until proven otherwise, this is going to be a really difficult one to step into on the long side. Next up, we've got Google. Really liking Google's activity here, especially paired with the fact that the XLC was an outperformer. Look at the lower wick, fake break of the bear flag, close right back up at the highs of the Thursday session. If we take out the 2-bar highs, 87.50, it's game on for the top of the range at 89.50. That's a clean look below and fail, especially right on the heels of a look above and fail, right? So this one just playing nicely in the range. I would watch for longs over the 2-bar highs for something that does this in Google. That lower wick is proving it to us, right? That the sellers kind of failed there. Meta is a little bit interesting up here at the highs. I really wanted more of a significant pullback to maybe close the gap there. Didn't happen. Nonetheless, still staying over the 124 top of this balance right here. So it's bullish until proven otherwise. Something that people don't realize is that Meta is almost up like 30-40% off the lows from November. Really significant move that's been unfolding here thus far. Watching for continuation. I mean, it's holding up nicely here as the market was breaking out of range. Watching for some upside over the hammer high. 136.50 can become the target. If it does pull back, looking for shorts only back down underneath 124. I would not really be in love with like shorting back down underneath the 128.40, underneath these lows in here. Just be patient, wait for the gap to possibly close. That's the trade setup that would start the short. And then if we continue through it, obviously your target's 114, the bottom of this area right around in here. Next up is NVIDIA. NVIDIA, just like Google, also had an interesting break of the Thursday low. You can see that lower wick breaches it on Friday. Then where do we rally? We rally and close right up at the top of this balance area from right here. So 149 is the breakout level into the early stages of the week. Let's not forget, this is still a counter trend move in this overall context of the bear flag, but taking out the top of the range, 153.50, daily 50 SMA, and we'll watch from there. The bullish structure would be finding a higher low above the top of the flag. The bearish structure would be look above and fail, target the bottom end of the range back down to 142.50. Next up, we've got Softy. What's going on with Microsoft? Same thing as Google, to be quite honest with you. Although the structure is not similar in terms of a balance, the psychology of the lower wick is certainly the same, right? Big failure from the sellers. There was some early morning momentum under the Thursday low. Where the buyers close it, right back up inside of the Thursday range. I would watch for some bullish outcomes here, possibly over 226.15. This really requires the hourly chart to illustrate, right? So if we get some consolidation and a break here, this is probably a day trade, right? This is not a swing trade. This is a day trade, and then watching for continuation possibly through the thin structure, but one step at a time. I would play cautiously in Microsoft on the long side. We're only playing for a dead cat bounce, right? Just like many things that we've seen thus far, let's not forget that we are technically in a downtrend, but the structure down here, the psychology would suggest that buyers do have a bit of an upper hand. Next up, let's take a look at, last but not least, the mini beast. We've got Amazon. Same idea. I hate to sound like a broken record, but look at the lower wick, fake break, right to the top of the range. As we've pointed out in the past, I think being patient for the 87.75 break is more meaningful inside of Amazon. I would not be overly enthused about a long in this chop area until we can recapture the lows. That to me is much more impressive. Also retargeting that daily 50 SMA, the blue line. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about. And let's dive right into these trade ideas, kicking things off with PDD. This is, of course, a Chinese company. Of course, it's listed as an ADR here on our exchanges. However, with the restart of coverage from a couple of firms as announced in the headlines this past week's worth of trade and the possible reopening of China trade, the 3-bar play was too good to ignore. So even from a technical perspective, forget about all the fundamentals. Look about the technicals. You've got 1, breakout bar, 2, inside resting bar, 3, we're watching for a break of the 2 equal highs for continuation in the upward direction. This, of course, is in a nice little uptrend here, so it's pretty hard to argue that we're going counter trend. If we even scrunch up the chart, right, we don't have much in the past year's worth of trade off to our left. We've got to go a little bit further out in time, of course, building out more of a rounded bottom. But what do we have for resistance overhead? You could start to look at this as a break cleanly over this area here, and the target would be up here, right? So really some sizable overhead room to run up towards 101.83 in PDD if this breakout does ultimately unfold in the upward direction. I want to see, of course, respect the low of Friday at 92.79. Last but not least, I've got HD for you, Home Depot. What's going on with the depot? Same idea that we've been covering inside of many of the companies in the core list, right? Long lower wick, fake break underneath the bottom of this balance, fake break underneath the 50 SMA, closing back inside of the balance. There's an opportunity now. Let's clear up this drawing set and point out what we're watching. It's up and over these highs at 321.20 basically, or 321, let's call it 322, excuse me, rounding up there. We've got some thin structure. You could easily make the rotation to 329, and then after that, it's this big spike high, right? So plenty of room to run in the upward direction. Your risk is tight underneath the low of here, looking for a break and some upward action inside of Home Depot. Looks like some sellers got trapped on the Friday session. So that's going to wrap up the video. Hopefully we'll see you at 8:30 to check in for the pre-market prep live here on the channel. With that being said, everybody, be mindful of the CPI data that comes out on Thursday. We'll update you on the Wednesday midweek market update, and I wish you all a green trading week.